much. I'd like to introduce our esteemed panelists. I'll start off with Amr Nady, Head of Hotels and Hospitality and Global Hotel Desk at JLL. Andrew Love, Head of Middle East Capital Markets and Commercial Agency. James Wrenn, Head of Capital Markets at Colliers. And Vijay Raghavan, Director, Golden Sands Hotel.
Oops.
So thank you everyone for joining us today for this insightful panel discussion where we will look at hotel transactions in 2023. The hotel industry has witnessed a significant rebound post the pandemic, and we're seeing increased deal flow in 2023, and the space continues to evolve. Today, with our distinguished panel of experts, we'll provide insights, and I'd like to explore the current state of the hotel transactions, the emerging trends, and dissect the challenges and the opportunities that lie ahead. So, starting off first, I'd like to kick it off with a question to James. From your experience, what regions or markets have seen the most significant activity in hotel transactions?
Few technical problems here, but I'll try to answer the question. Yeah. Good afternoon, everyone. Great to be here. Yazan, I think to summarise, really, I would say it's the UAE market is the most active at the moment. And I think if we had to choose two locations, obviously where we are, I would say the Northern Emirates, Ras Al Khaimah. There's been an amount of transactional activity there. I mean, 3 significant transactions over the last 12 to 18 months. We saw sale of the Rixos last year, the Doubletree on Marjan Island, Marjan Island Resort just in the last couple of weeks. So good transactional activity from that. Obviously, there's a lot of land transactions taking place as well, and rising market in general there off the back of the Wynn announcement. In Dubai, then, I mean, not even in last year, but I'd say even pre-pandemic, we've seen some transactions taking place, portfolio transactions, some divestment from some of the semi-government entities, and we've seen that continue after the pandemic as well. So I know there's quite a number of large deals under offer and under discussion at this moment in time, and I suppose we'd be quite hopeful that some big deals will be agreed and across the line over the course of the year. So I would say UAE, and I would really focus on RAK and Dubai, really.
Great, thank you. And from these transactions and from the deal flow that you're seeing, what are the most common reasons for selling that you're seeing? Why are owners looking to sell or divest?
Yeah, I think, look, the biggest reason is the strength of the market at the moment. It is a good time to sell. I think our colleagues in the previous panel alluded to it as well in the introduction. From an operational point of view, EBITDAs are strong. We all know hotels are valued based off the strength of their P&Ls. And I think, post-pandemic, we knew 2020 was a tough year, but things came back fairly quickly in 2021. 2022, from EBITDA perspectives, we saw especially the resorts, smash all records, huge increases in profitability, sometimes reduced costs. In other markets, costs have gone up. We've seen in this market, sometimes there's been some squeezes on the costs. And then that's continued into 2023. So from an operational perspective, the resultant P&Ls are quite strong. From market sentiment, we know the real estate market is quite strong, especially in the UAE at the moment. We see that in the residential market that's actually spilling over to commercial real estate as well. I think a second point is a lot of hotels, from a life cycle point of view, a number of owners will be looking at, maybe they own the hotel 10, 12 years now, it's coming up to a big refurbishment cycle, the market's quite strong, now maybe it's a good time to sell. And then thirdly, a lot of owners, maybe they're looking to refocus their own businesses. We saw again over the last decade, maybe a lot of developers were induced into the market in the mid-scale space in particular. There was a lot of inducements in that to develop properties in that space. And they maybe moved away from their core areas of being residential developers or more traditional commercial real estate developers, and they feel now is a good time to sell, and they're trying to refocus their business and maybe put some cash back into those traditional areas again.
Perfect, great. Just kind of getting a different perspective. Amr, where is the interest coming from? Is it international buyers looking to invest in the UAE? Is it local buyers investing in a different cities within the UAE? Is it inbound, outbound? Just shed some light on that, please.
No, I think the trend is fairly similar across the years, that the region has been mostly a net exporter of capital rather than a net importer. And I think at this stage, if we look at some of the trades that happened and some of the trades that are expected to happen over the foreseeable future, it's mostly regional interest. But it is the first time we're actually starting to see more and more inquiries, which is, I think, is a great starting point, because that's effectively how you create an investment market. It's a little bit like when we work with the Middle Eastern community that want to deploy capital abroad. They'll ask us about the US, they'll ask us about South America, Asia Pacific, other key destinations, the Maldives, for example, right? We've concluded deals in Australia, for that matter. So I think the cycle is shifting in the sense that the more and more trades that you start seeing, you're starting to create a transparency even at a global level, because I think Dubai as a tourism destination has already positioned itself extremely well. So now it's time to look at the second layer, which is the investment market, right? The hotel ownership side, the financing side. So to my predecessor's point around what sort of financing they can get, the sort of legal advice they can effectively look into when it comes down and acquiring a commercial real estate property in Dubai. We've seen so much happening in the residential space, and from that there has to be some form of derivative effectively onto the commercial side, whether it's skewed towards hotels or not. That at this first phase, it doesn't matter. Create an investment market on the commercial side, and then the hospitality asset class will get its fair share.
Thank you for that. A lot of investments, a lot of people are looking to invest in here, right? And whether locally or internationally. Andrew, what are you seeing? What hotels are in demand? Investors, what yields are they looking for? What are the transactions, and how, what are they achieving today?
Yeah, so I think if we go back to what James was saying, I think probably from 2015 to 2020, probably count on one hand how many transactions there were that we could probably say were arm's length.
Yeah.
I mean, in the last 2 years, there's been probably 10 transactions, which is more than that was probably there combined from those periods. So post-COVID, it was very much 5-star beach resorts, and that was kind of in line with the recovery of the market. Look at the Palm Jumeirah, Ras Al Khaimah. They rebounded pretty quickly, and we saw a lot of investment demand for that. James mentioned we brokered the DoubleTree Hilton deal to Aldar. Fantastic hotel, recovered very well post-pandemic. And I think the investor, Aldar, when they were looking at that deal, they said, well, look, we're not getting these returns in other asset classes, so this makes sense to us. And that's turned out to be a sort of very good play for them, where they've had yield accretion. Talking about yields, like any asset class, it's not just simple to say it's 7 or 8%. It depends on the age, the location of the hotel. Does it need capex? If we use the DoubleTree Hilton as an example, you were trading that at probably a 7% cap. But today, based on today's recovery and the figures it's doing, it's probably doing closer to 8.5%, maybe even touching 9%. I think if we're looking at today in the local market, if it was a prime beach resort, you're talking something like a Four Seasons or a Mandarin Oriental, I think that would be on a par with global hotel yields, probably dipping as low as 4.5%, 5%, but you don't see them transact. Yeah. We're involved in a hotel sale right now in downtown, and that's trading around about 6.5%, which will be a record price point. If I took myself back pre-pandemic and using sort of 2018, 2019 figures, that yield would have been probably mid-sevens, closer to 8%. But in line with the wider maturity of the market, new buyers entering, I think they're now seeing Dubai as a sort of attractive place to invest. And compared to other markets like London, Paris, Madrid, Barcelona, Sydney, the yields are still relatively attractive.
Great, thank you. Back to you, Amr, giving us the international perspective, and maybe Vijay, you can chip in from a local investor perspective. What are your views what are the current challenges in the market and barriers to entry to international investors coming in or local investors looking to invest in the region? How can we make this more transaction friendly? How can we stimulate activity in the market?
Okay. Really put me on the spot there. Listen, I think the barriers to entry are very similar to just like any other global market. Any investor wants to know, first of all, how's your top line? How are your assets trading, right? And how effectively all of that translates into performance, right? So what are your cash flows? So again, referring to our previous predecessors on the financing side, right? And then you look at labor laws, ownership laws, freehold regulations. Where can we invest? Where can we deploy capital? What are the elements, or let's say sub-markets within a certain region, a certain country, a certain city, where it becomes accretive for that international investor to leave his home base and diversify it over here. So there has to be some sort of value offering that entices people to effectively come into the Middle East. Now, we've seen a lot of progress over the past 3 years, to Andrew's point, and I think if you want to compare returns, listen, 100%, and we're seeing that even on the outbound side. We're seeing so much economical headwinds, financing headwinds, labor headwinds in certain parts in the U.S., for example, and you started to see even the shift of capital moving from the northern side to what they call the southern smiling belt, so i.e. Florida and pretty much all the southern states, because they don't have union, for example, laws, or they don't have organized labor onerous regulations. So these are things that go above and beyond the pure economic reason. Now, I think this year, if I had to put just a guesstimate, I think we're probably going to be around 30 to 40% decline in global investment volume compared to last year. The type of investors that we're currently working with has shifted a little bit from your dominant private equity to we're starting to see a lot more institutional. We're starting to see a lot more sovereign activity. It has to be investors who can effectively conclude transactions or really be active in the M&A space without being too exposed into the financing side of things. And then they would take a view maybe 12 months down the line, 24 months down the line, when the debt market normalizes a little bit, we could be looking at a refi. I think in Dubai, or the UAE generally speaking, like I said, the more trades you create, the more market you create, the more sound and voice and echoes you're going to be effectively creating. It's a bit of a snowball effect, right? So you're going to have the capital coming from Asia Pacific coming to inquire, from the subcontinent, and then that will drive effectively investors, to look from more mature markets to look at the region. You look at the Maldives, for example. The first trade that happened in the Maldives was 11 years ago. Now we're talking about over, $2.5–3 billion worth of trades in the Maldives. We had the Blackstones of the world coming to invest. We've had European lenders coming to consummate financing packages and provide facilities for international investors to acquire assets. Why? You have that transparency. It's been there. You have an established mature market.
And I think just to add to that point, you can see it happening, right? In August 2022, there was the investor promotion law, and not many people know this.
Yeah. Fully agree.
And it's still finding its feet, but what that law says is that if a foreigner sets up a fund in a DIFC, and it specifically says the DIFC, they can own onshore assets. It means, they can own assets on Jumeirah Beach Road. So that ecosystem is changing. You'll start to see more FDI, but as Amr says, you've just got to find its feet a little bit. We're receiving the inquiries, and I think whoever dips in their toes first out of these big guys, you'll see more then follow.
Thank you. So talking about kind of pricing and valuation, right? Do you think that there has been long-lasting impacts, since the pandemic that are affecting pricing and valuations today? Maybe James, or Vijay, please.
Internationally, obviously, the number of transactions post-COVID had certainly come down, especially till the middle of 22, although it's picked up post that. Obviously, that is based on the fact that 20 and 21 were relatively or substantially lower performing years for the hotels, and no owners would like to bring to the market a property which has had 2 bad years for reasons which are internationally well known. The interest is going up, but for groups like us, investments internationally was more for geographical diversification, not necessarily purely based on returns, which obviously was the highest in Dubai and in the UAE. We remain focused on these markets. Yeah, but we are open to international markets, although with the current cost of financing, it continues to be a challenge to find spread over your cost of financing. I mean, we don't get that kind of yield in any of the cities mentioned by Andrew, or even in Eastern and Central Europe. You don't get those these days.
Yeah. Okay.
Yeah, I think just kind of the effects like post-pandemic on valuation. I think in this region, like kind of alluded to initially, we bounced back very quick after COVID. We've seen profits exceed pre-COVID levels. So the pandemic hasn't really affected. It's actually driven prices up even further due to the kind of post-COVID boom in this region. Internationally, we know there's a lot more difficulties taking place. Labour, alluded to earlier on, is a big one. Cost bases, like in the UK, speaking to one of my colleagues earlier, you know, they're looking at utility prices doubling in hotels. From about, you know, in luxury hotels in London might be like 4% utilities traditionally, now up to 8% of revenue. So that's having an effect on EBITDA levels. So I think in our region we've been blessed. It has a positive effect on valuations, but you know, other markets across the world haven't bounced back as quick. And I think I would just add a point as well in terms of like valuation due diligence, especially from a buyer side. I think it's gone a lot more prudent since the pandemic. I think if we look back over the last 10 years, even across the UAE, and I suppose we since like, let's say pick a year 2013, 14, the market was very strong. I came to the market then 15, 16, the effects of the oil crisis. I mean, EBITDA levels did go down across many of the markets in the Gulf. We've seen a huge amount of supply entering the market during that period as well, 16, 17, 18. We saw ADRs then kind of recover 19, 20. And I think all that's in the mindset of buyers that, look, if you look forward and you're doing your projections over the next 10 years, you're doing your valuation, you're doing your DCF, it's not going to be all rosy. We know we're on top of the market now. If we get another year, if it's as strong 2024 as 23, it'll be blessed. But there will be ups and downs over the next number of years. So it's just trying to pick a kind of stable level of EBITDA over a 10-year period.
I also think we'll see a bit, I don't know if you're seeing the same, there's a bit of a two-tier market. We know the hospitality industry is performing exceptionally well, but I think hotel owners, if they've not got location and they haven't invested in their assets through capital expenditure program, those are the assets that haven't seen value recovery.
Yeah, and there's a two-tier market as well, Andy, in terms of pricing. I mean, there's like, you know, there's a number of assets on. If you're looking at, look, 1 billion dirham assets, there's only a handful of buyers in it for that market. If we're looking at assets between 200 or 400 million, there's another quartile of buyers in on that. So there is different parts of the market. I would fully agree.
So, you know, from a hotel owner and investor perspective, Vijay, what advice do you have for investors looking to enter the market today, and what should they look for?
Obviously, any kind of property, the first criteria is the location, and that drives most of the decision making, and that should. And if it is an existing operating property, the operators who are running it and the brand makes a key part of the decision making. And of course, the historical performance of the property in terms of its efficiency, both in driving the top line and also the bottom lines, because with such fine margins over financing cost, you need to be absolutely sure that the properties are under the most efficient level. And having said that, some of the challenges we are seeing is, although we don't have challenges, we never had the challenges of getting manpower here, even during the worst times of COVID. One of the biggest challenges all the hoteliers are facing is retaining the best talent with them. With so much happening in the Emirates and in Saudi, the attrition rates are going up, and every general manager, I'm sure, is having to face the need to talk to one of the senior persons, whoever it is, on an ongoing basis to retain them. And that's one of the biggest challenges which we are facing in this market today. It's good, it's because the market is doing well, but it throws up its own challenges on the back end.
So, Andrew, from a kind of advisor perspective, right? What considerations should someone consider when they want to buy or sell a hotel from your perspective as well?
Yeah, I think as perhaps James has said, is that the market certainly evolved. I remember when people would just buy off a price per key, no due diligence. And that doesn't really happen nowadays. Still happens, but not as much. So, when we're taking an asset to sale, I think the most important thing is considering that execution risk. I'm not saying execution risk does not exist in more mature markets, but it's compounded here. So you've got to really prep that asset for sale before you take it to market. So, in this country, the SPV, you're buying a transfer of going concern generally because the license pertains to the asset. You're not just transferring a physical title deed. So you have to think about bank accounts. You need to think about that SPV holding. Does it own other assets? If not, you need to set up a new SPV and you need to prep that data room. You need to have all the staff. You need to have all the information on the OMM manuals, the AMC contracts, the as-built drawings. And sometimes that process, perhaps when they took handover from the contractor, they don't have all those documents. So prior to taking an asset to sale, this is what we sit with the seller and say, look, you've got to do X, Y, and Z. We'll build a data room around it, the investment memorandum, and only when that's done, we'll then take it to market.
Okay. But that's kind of when the asset's kind of built, right? So I think the process to exit or your exit plan should start at a very early stage. So kind of, James, maybe from your perspective, developers at their planning stage, what do they need to consider from a design perspective, from a structuring perspective, to enable the exit at a later stage?
Yeah, I think, to tweak a phrase, maybe the day you develop is the day you sell. So if you're developing an asset, I'd say number one, on the design side, look, you have to make the development as efficient as possible, because we don't know in the future, like utility prices, increases, things like that. That all has an effect on the profitability of the asset. So operational efficiency is very, very important. And I think developers and operators in this region have learned. We've seen a lot of hotels that have been over-spec'd in this region. I think that's stopping now. We're seeing more efficient developments and better uses of spaces. I think secondly, from like a legal perspective, we've seen the rise of branded residential. It's a phrase that's used quite a lot as a kind of trend that's happening in the market over the last number of years. But let's call them maybe hotel investment products, which have been in the market now for a number of years, where some owners maybe have sold off hotel rooms. And I think there's been maybe mistakes made over the years sometimes in that respect. And I think if a buyer is coming looking at an asset, they want the asset to be as simple as possible. If there is a branded residential component, maybe it's in a second tower, or maybe there's separate access, so the hotel-specific areas are very, very clear. There's clear documentation around them, and the asset is very clear to identify and sell. I think that's very, very important, and I think that's more going to become even more prominent now with the rise of the branded residential. And then thirdly, from a buyer point of view, look, I think maybe you mentioned it earlier about like hotel management agreements, or we did when we had a bit of a talk earlier on. Like from a hotel management agreement, for assets that are a bit newer, obviously you want to make sure that the fees are as competitive as possible. The clauses are user-friendly, especially when you're maybe going to undergo through a new asset management structure when a property's been bought. I think from a buyer's point of view, I know there's a lot of owner-operators, maybe especially international owner-operators looking to come into the market here, and I know obviously it's probably dominated by local and regional investors at the moment, but in time it will change. There'll be more international investors. They preferably would like, if they're owner-operator, maybe to have the ability to break a management agreement. I know it comes up in hotel management negotiations quite a lot, of having a break option in a management agreement upon termination upon sale. But obviously that's not in the operator's favour. Obviously they've put their brand out over the property. They've invested in it over the years. It's their brand, and there'll be a lot of issues if the brand may be lost or got taken off a property. So I think maybe from a developer's perspective, it's very difficult to get that clause included. An operator won't agree to it. So that's something from a buyer's point of view, that if they are taking on a property, to work then with the new owner. And I suppose you are looking for, especially new management agreements that have been done over the last number of years, to be done in a competitive manner, really.
Thank you, James. So, back to you, Vijay. From a sustainability angle, how do you see sustainability and environmental factors playing a role in hotel transactions today? And what are you doing in your current hotels today from a sustainability angle?
It's something which everybody is starting to give higher importance as the day goes by, and that's the only way to go as we lead into future with more growth. We are still in the initial stages, but we have still done a lot of things in the hotel. Probably a lot more can be done. Some of the things we have done are, we have obviously done away with plastic bottles across our 4,000 to 5,000 hotel rooms and hotel apartments, and we have put in bottling plant within with reusable bottles, mostly glass. We have gone for a lot of solar panels in not only our hospitality assets, but a lot of our industrial and other assets also, whereby we are diverting the power generated into the grid to the extent possible. And we are also resorting in some of our properties to garden farming, where some of our requirements are delivered out of the garden, grown in the backyard, or on top of the parking building or somewhere. So which is currently a small portion of what our total procurements are, but we are still on the increase. So there are more to be done, and we are conscious of that, and we are looking at sustainable option wherever possible in terms of having air conditioning and lighting linked to remote access kind of situation where it identifies guest entering, the temperature adjusts automatically in the room. These are small things which we are doing. And we still have a long way to go, but we are conscious of the route.
Great. So, Amr, from your perspective, is sustainability a requirement for international investors coming in and looking at hotels? Is this something as a mandatory checklist on their agenda?
Only within their own domestic market. So to get a proper ESG accreditation today, the funds have serious obligations that go upon even before completing sales or acquisitions. There has to be some criteria around ESG. So I think there's a lot of focus around the environmental elements, just like Vijay mentioned, but there's also the SG element that falls into it as well, social and governance. And I think to drive that movement into a hyperdrive, there's a lot of work at a compliance level and governance level from the authorities, effectively, that need to occur, basically. And it has to be a bit of a role model in respect to either new developments, new projects, refurbishment plans. All of that has to be taken into consideration. Unfortunately, the hospitality industry is one of the industries that lags the most behind all other asset classes. And that comes with certain complications, effectively. So I think in this part of the world, there's a lot of progress that's been made, but if you really want to see that at a scale level, you're going to start seeing regulations being issued that are related to licensing, to permitting, at a design level, at a developer level, at an operator level, at an employee level, even for that matter. So there has to be a bit of a push on that front. Now, is an international investor, does he need to be ESG accredited, or does he need to take some form of ESG initiatives if he needs to deploy capital either across the Atlantic or across the Mediterranean? No. He doesn't have to, but domestically they do. That's 100%.
Yeah. And it will continue to be an important agenda, and it will be more of a requirement for
100%.
investors, whether locally or internationally,
100%.
that they need to have. Okay, so just kind of conscious of time, we've got 2 minutes left, so I wanted to wrap it up by, opening a question to each one of you to say, what would you like to see in the market to encourage transactions in the future? One thing that will, from your perspective, from your backgrounds, that will help encourage these transactions. I'll start off with you, Amr.
Listen, I'll play again on the financing side. We've seen again from our, the previous panel, the discussions around top tier investors and afterwards. And I think that level of segregation does exist globally, but we're seeing it less and less in that respect. Today, we have no issues of formulating or putting certain products to either sovereign funds or institutional investors or private capital, singular, multifamily, family office, you name it. We know for a fact that the financing market is so competitive, it's still going to be very accretive for them to do international acquisitions. And that has to be a bit of a vice versa exercise here. The sponsor is important, 100%, but today we need, I think, out of your traditional lenders, I would say 20 or 25% of them really understand fully the hospitality model. And in that respect, I think if we get bigger proportions along the lines, then we can start talking to the top PEs and the private equities of the world, basically, in a more comfortable manner.
Andrew?
I'll keep it short because at the time, I think, look to encourage FDI, foreign direct investment, and the big institutional investors probably need to see a bit more maturity in the UAE laws, whether that's the court systems, and probably still opening up foreign ownership areas. While Dubai have the law, Abu Dhabi is still quite restrictive on foreign ownership. Saudi at Yath, it's investment friendly, but mainland and other areas, it would be good to see that open up in the same with other, like Sharjah have recently done with their laws.
Sure, sure.
We are open to acquisition, as I mentioned earlier, willing seller, efficiently run property with a good track record, and reasonable expectations from the seller. We are
James,
open for
3 seconds.
One word: agency needs to improve. I think if we see the market at the moment in the UAE in particular, there's a huge amount of people attempting to sell properties, maybe not qualified to do so. I think it's not good for buyers, it's not good for sellers. So I think on the agency side, I think everyone in this community, the FHS community and everyone on stage here, I think we all have to play our role to educate buyers and sellers to run proper structured sales process for a win-win for everybody.
Thank you very much for all your insights, and thank you for attending. Thank you.
Thank you. Thank you, Yazan.